If you've been investing in mutual funds for years but don't know when to sell them, in this video, I will tell you 4 scenarios in which you should consider selling your mutual funds. And by the end of this video, you will be able to save a lot more time and protect your wealth creation journey just by understanding when to exit a mutual fund. So stay till the end. Number 1, consistent underperformance. The first reason you can consider selling your fund is if it's consistently underperforming. See, a mutual fund has 2 simple jobs. First, beat its benchmark. Second, perform well against its peers or its category average. That's why we need to compare the rolling return of our fund to the benchmark. Rolling returns measure the fund's annualized return across every possible start date inside your sample window. And we will check our fund's rolling returns against the total return index of its benchmark. TRI assumes dividends are reinvested. If the fund's rolling return line is below the benchmark TRI line for a consistently long period, that's a problem. One way to ascertain the performance of the fund is checking its CRISP score. The C in CRISP stands for consistency, wherein rolling 1-year returns of the fund is measured over a 5-year period and compared against its peers. Number 2, key manager exit. The next big reason you may consider selling your mutual fund is when your fund's manager leaves. A fund manager often carries the investment process, tacit knowledge, and stock selection instincts that produced the return of your funds. That's why you buy an actively managed mutual fund. You're not just buying a basket of stocks. You are paying a fee for a specific fund manager or management team who will, hopefully, provide you with better returns than the benchmark. So what should you do if your fund manager leaves? Check who is the new manager. Were they an internal analyst? Then check if your AMC is process-driven or manager-driven. Some AMCs are largely process-driven, which means the funds have a higher chance of staying stable even if the manager leaves, while some other AMCs might be manager-driven, where the manager decides the entire strategy. In these cases, you should closely monitor the fund's performance. Finally, check if the new manager is using a different strategy. For example, if your value fund is suddenly buying high growth tech stocks, that's a strategy drift, and it might be time to sell. You should never sell on the news of the exit. You should only sell if there is a decline in performance or a change in strategy in the 6 to 12 months after the exit. Number 3, investing in the wrong fund. Another reason you may consider an exit is when you have invested in the wrong fund. Let us take an example to understand. Say a new investor picks a category purely based on past returns, but as he matures as an investor and figures out his asset allocation, he understands that it is not where he should be investing. In such cases, investors would be better off redeeming their investments in the earlier fund and choosing the fund that suits their goals. Sometimes the best reason to sell a mutual fund has nothing to do with the market, the fund manager, or the performance. It has everything to do with you. You sell when you've met your goals. The goal of investing is not just to increase your wealth. The goal is your house's down payment. The goal is your marriage. The goal might even be your retirement corpus. So when you've met your goals, you should sell your funds. And that's it. This was everything that you should know about selling mutual funds.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.